Once again, welcome to another video session with Tankrich. This is our video series on Warren Buffett's shareholder letters, and today we're going to talk through the letters of 1962 and 1963. I've clubbed them together. Those were partnership years, so they were small letters, and we would have an opportunity to club them in one video. So now, if you're a first-time viewer and if you're watching these videos for the first time, I would highly recommend you to go back and look at our introductory video, because that's going to give you why we are doing these videos and what you can get out of those videos. Now, over to the letters. Now, today we're going to talk through the 1962 letter again, which I've got here, and what basically we got from the 1962 letter was two important lessons, and I'm going to talk through the first one, which was power of index investing. Now, right through 1960s, Warren Buffett put up his performance against how he was doing against the indexes and against the large mutual funds which were existing in US at that point of time. And he had a very clear view that as a retail investor, uh, when you invest for a longer horizon, it is very difficult to beat passive index investing, and he showed this through numbers. And again, I would tend to quote from his letter: to the extent that funds are invested in common stocks, whether the manner of investment be investment through companies, investment counselors, bank trust departments, or do it yourself, which some of us would do, our belief is that overwhelming, now look at the word that he has used, overwhelming majority will achieve results roughly comparable to the Dow. So on a longer horizon, it is very difficult to beat general indices. So if you are short on time and if you don't want to get into active investments or finding undervalued securities, what would serve you best is get in and buy an index fund, a low cost index fund, and participate in the growth of the country, and participate with a large cap or a mid cap companies which are there on the index. Usually, a index will have large cap companies until unless you opt for a mid cap index. That was our first lesson from the 1962 letter, a fairly obvious one, and which helps. And I think this was repeated even in future years, even in the latest 2015 letter, where he says that for a retail investor, the best bet, if he does not want to get into active equity investment, is to invest in index. The second thing was what would make you shine in bear markets, because it's all good. We are in a bull market, everything is going to rise. But what happens when things turn their tide, and when we get into bear markets? The thing which is going to save your portfolio in bear markets, and this is where we would again go back and listen to what the great man has to say, was his performance, which was really good in that particular year, was because he was able to invest his money into a controlled situation. And this is where I quote him. He says that this performance is mainly the result of having a large portion of our money in controlled asset and workout situations rather than general market situation at a time when Dow declined substantially. Now, as a retail investor, we might not have an opportunity to invest in controlled situations, because we always don't have that capital which is available with us, which we can invest and get into a controlled situation for a get into a controlled situation within a company. But we can always invest in workout situations. Obviously, that would require a little level of due diligence. We need to know what corporate action would trigger that workout situation. But again, the only way to shine in a bear market, as per Warren Buffett, this letter was if you are invested in control situation and in workout situations, because these are generally insulated from what the general market is doing, and that's one of the major key takeaways which we got from the 1962 letter. So moving on, what the 1963 letter has to offer. And again, all Warren Buffett's letter were immensely distilling wisdom for any new investor. So I've repeatedly told that these videos are not an alternative for you to go through these letters. 1963 letter again was a little big from its 1962 letter, because there were tables and statistics where he was comparing his performance against various mutual funds and indices. Now, what does 1963 letter has to offer? Again, three very important and key things which we get. And listen, folks, 1963 gave us very important investment tenets. So listen on carefully. The first thing that we got to hear from Warren Buffett was magic of compounding. Now, compounding is always referred to as the eighth wonder in investment. And a lot of people don't know, even though they are senior investors in equity markets, they move in and they move out, they don't understand the real power of compounding. Warren Buffett actually used a table and to decipher and actually made people aware of what compounding can actually do. So he took an example where he said that if you put $100,000 at 5%, 10%, 15% for 10, 20, 30 years, it is very startling to see how relatively small differences in rates add up to a very significant amount to years. So let me give an example. If you invest for 30 years at 5%, $100,000, you end up at 400 odd K. While if your money is compounding at 15%, and that's what Warren Buffett did throughout the last 50 years of his investment career, that becomes a mind-boggling $6.6 million, a life-changing figure. So even though the rate is a slight difference, we're talking about 5 to 15. Okay, let's take an example of 10%. The 10% itself, when you compound at 10%, it's $1 million. So with 30 years, with a 5% rate difference, the investment returns are 6 times different. Can you imagine that? 6 times. That's the magic of compounding. And again, if you're a serious investor, this is the first thing that you should know, that your real returns come through compounding. So if you are going to have a 100 bagger, the stock will become a 100 bagger in the later life of that particular investment. It's not going to become a 100 bagger in 1 year or 2 year. Only if you have conviction to hold a company for a long period of time, if it is performing well, then only you will have multi-bagger returns. That's for you the magic of compounding. That was our first lesson from that 1963 letter. The second, again, a very important lesson for investors, was the lesson on margin of safety. Now, Warren Buffett did not use the exact words from his guru, the margin of safety, but what he quoted, I'll again refer to the letter here, was very simply that if you have margin of safety when you're buying a company, at most of the times your investment decision will work out. I'll refer to the lines which were there in the letter, which attracted my attention and gave me this insight. He says that, and I'll quote him again, "This is the cornerstone of our investment philosophy. Never count on making a good sale. Have the purchase price to be so attractive that even a mediocre sale gives you good results. The better sales will be frosting on the cake." Now, what does this tell us? That if you take care of buying, most likely in 90% of the cases, the investment decision would work out for you. The reason is, if you have margin of safety when you're buying, you would tend to make good profits even if you had a mediocre sale. So that was very key important. And as a retail investor, always price what you pay to acquire an investment is the most important factor. Although understanding business, valuation are the two important factors, but for me, the number one is price that you've paid for the investment. Now, moving on, the third and the final key takeaway from this particular letter from Warren Buffett of 1963 was what kind of mindset that you need to have when you are evaluating investment results. Now, look at how he's thinking. He's putting emphasis on long-term results. He's putting his emphasis on creating wealth and not making a 5% next day in the equity markets or a 20% in over a month. What he really wanted to do was pile up yearly advantages over what would have you've got when you would have invested in Dow. So, and again, I'll quote him here is, our job is to pile up yearly advantages over performance of Dow without worrying too much about whether the absolute results in a given year are a plus or a minus. Very, very important. Don't think about whether your absolute results were a plus or a minus. Think about, have you been able to beat markets, especially in years where market has overall has not done well. This is how he wanted us to think or have a mindset around our investments. So again, 1962, 1963, these were the key insights or the key lessons that we learned from Warren Buffett through his partnership letters. Again, what I would say is go back and read these letters. Uh, Share in comments what were the additional insights that you got from these letters. I hope you liked this session and this entire series. Go and watch other videos for other years, and we hope that we hope that you would hit the subscribe button, and we'll see more videos which are coming in this series. Thanks for watching again, and I'll see you. Bye.